Hello everyone and welcome to today's webinar brought to you by the Chartered Institute of Export and International Trade and Currency Solutions. The topic for today is how to manage volatile currencies in turbulent times. In an increasingly volatile business environment, during a war in which almost half the planet goes to the polls, businesses need to be aware of the risks around currency valuations and how it impacts their international trade. Firms also need to make sure they have a strategy in place for managing the potential risk of a currency fluctuation that could impact the value of their transactions between the point of sale and the completion of the order. Luckily, to take us through this difficult topic, we have two experts who are well versed in the rocky world of foreign exchange, or FX. On the next slide, firstly, from the Chartered Institute, we have Garima. How are you today, Garima?
Hi, Phil. Thank you so much for having me over.
No, great to have you back. How are you doing today?
Doing good. How about you?
Just excited to get this started to go through this webinar.
Yeah, same here.
Thanks, Garima. We are also delighted to welcome James Tinsley, Senior FX Dealer at Currency Solutions, as another one of our guests today. James, how are you?
I'm very well, thanks, Phil. Thanks a lot for having me along. Looking forward to it as well.
Pleasure. Thanks for joining us. We really look forward to getting to this ever important topic, and we're delighted to bring you two experts to talk to some of the people who've registered today. However, before we get into this the presentation properly, on the next slide, I'm going to introduce the first of our polls while I run through some basic housekeeping notes. So, what is the biggest issue you face when purchasing foreign currencies? So if you just let us know your thoughts. Firstly, apologize to any of our YouTube listeners that you aren't able to vote in the polls, but thank you all the same for attending. So just to remind people, everyone attending today will receive a copy of the webinar slides and a recording of this session in a follow-up email. We'll be sending out this out over the coming days, so do keep an eye out on your emails. We'll also be reposting a version of this on our YouTube channel. As this is a Q&A section, we will be taking questions from the audience, and you use the Q&A function on your GoToWebinar tab somewhere around here on your screen. However, just as a reminder, we do advise people to keep their questions as general as possible to allow us to answer to a wider range of people as possible. So with that in mind, try not to make them too industry or company specific. And it's just a little favor from me. If you keep any questions as short as possible, it does help me read them out when it comes to it. So let me just check on how many people have voted. So most of you have voted. I'll let that run for another couple of seconds. Okay, so closing it in 5, 4, 3, 2, 1. Okay, thank you everyone. So the biggest issue people have mentioned is understanding rates. Oh, sorry, volatility in the market with 53%, with 40% saying the biggest issue they face is understanding rates, and about 7% saying accessing a broker. Garima, James, what do you make of this kind of result?
It looks like people are generally concerned about the volatility in the market, and that is also going to be one of my slides. And there I would like to emphasize the importance of monitoring exchange rate fluctuations, minimizing transaction costs, and being informed about market trends. So yeah, it will be interesting to talk about those.
Yeah, from my point of view, it's really good. My slides that we'll be going through shortly cover the volatility in the market and kind of how you can mitigate that as well. So I think it's really good to see that from the audience.
Brilliant. Thank you for sharing those insights. Useful as ever. However, that's enough from me. I'll be handing over to James on the next slide, where he'll go through the first section of the presentation. Over to you, James.
Perfect. Thanks a lot, Phil. Okay, perfect. So we're going to run through FX volatility and how to manage risk. As I said, my name is James Tinsley, and I'm one of the senior FX dealers at Currency Solutions. So my day-to-day role is speaking to our existing clients and basically speaking about their financial goals and how we can help mitigate the risk and basically make sure that they are providing a profit and it's not getting eaten away as the FX rates changed. So if we go on to the next slide, we can look through the contents. Perfect. So my presentation is going to be broken down into 3 sections. Section 1, we're just going to go through what is FX volatility. I don't know who's on this call, so we just make sure that we get everybody up to speed. What the causes of FX volatility, and then what effect that does have on exporters. Then section 2, we're going to look at some 2024 market risk, what's happening in the next 6 months and what that could do to the rates. Some of these things have already happened and we're just going to look at the fallout from them, and then some of these things are to come, such as the US election. And then on to section 3, we're basically going to go through what we offer, what products we offer our clients, and how they can use them to help manage that FX risk, along with some examples. So the whole presentation in total is about 17 slides and should take around 20 minutes. So if we go on to the next slide. Perfect. So I said section 1, FX volatility's impact on international trade. So what is FX volatility? So starting off with the definition, volatility is a measure of the amount by which a price fluctuates over a given period. In FX, volatility measures the difference between the high and low between a particular currency pair, and when a currency price fluctuates wildly up and down, it's said to have high volatility. Below is just an easy example of what we've seen in price changes in pound versus the dollar over 1 month, 3 months, 6 months, in a year. I actually did this last week, and even this morning that's increased more. So for example, 1 month we've seen over 3% changes in the FX rates. And if we go on to the next slide, we can talk about what causes FX volatility. So these are kind of the 7 main factors. First of all, we've got economic data releases such as inflation, GDP, employment data. These are released by all countries and come out, different data points come out kind of weekly. For example, we had inflation data out of the UK this morning, which is a little bit higher than expected, so the pound had a bit of a boost. An interesting fact on that is one of the reasons they think inflation has stayed high is because of the cost of hotel prices in the UK, and they think that's actually because of Taylor Swift and everybody going to see her shows. So if your mortgage rates don't fall, if you're waiting for the interest rates to fall to get a better mortgage rate and they don't, you can blame Taylor Swift on that one. On to central bank policies. This is interest rates, quantitative easing and currency interventions. So currencies derive their value mainly from the central bank interest rates. So if an interest rate is high, it should mean that the currency basically strengthens off the back of it. Quantitative easing, that's basically a way that central banks can print money into the economy. If they print more money, then there's obviously higher supply, so the price of a currency would fall. And then currency interventions, this is where central banks basically buy or sell large amounts of their own currency to change the rate. So for example, last Friday we had the Japanese central bank come in to buy a lot of their currency to basically to boost the price, to make it do better against the dollar because it's really weak at the moment. Political events, elections and geopolitical tensions. This will obviously change. We're going to look at that in a bit more detail in the next section as well. Market sentiment, risk appetite and speculations. This is to do with things called safe haven currencies. So for example, the dollar, the Swiss franc and the Japanese yen are known as safe haven currencies. So what happens when things start to go a bit wrong in the world and people start to get nervous, for example, if we see more wars, then these currencies normally do well off the back of it. Trade balances. So if a currency is exporting loads, then what we see is a higher demand for that country's currencies. Higher demand equals increase in price, so that will help strengthen it. And then also commodity prices. So for example, the Canadian dollar is very much linked to the oil price. So when we see the oil prices go up, the Canadian dollar does well off the back of it. On to global events, natural disasters such as big earthquakes, for example, in Japan about 15 years ago, that can tank a country's currency, and then also pandemic. So I don't need to remind anybody about 2020. Financial market performance, demand for equities and bond markets. What we see is when global equity is doing really well, then we see the pound normally does well. That's because the kind of the size of financial services in the UK economy. So we see a big demand of people putting money through the city, and sterling does well. If we could just, well, what these basically mean is you can see there's a lot of different factors that are affecting currencies at all time, and these are all kind of imbalances, kind of balancing out against each other, and that's why you can see such big shifts in the FX rates, because there's so many factors that go into it. Cool. Can we go on to the next slide? Thanks. So how does this actually affect exporters? So changing the FX rate will make their goods and services either cheaper or more expensive. This can lead to profit margins being eroded. For example, an exporter working on a profit margin of 10% could lose half their profit margin working on a 90-day payment terms, as we saw a couple of slides ago. If we see over 5% volatility in that 90 days, if you agreed to get paid in dollars by a client overseas, and then after those, and you agree a set amount of dollars that you're going to get back, and then you need to sell that back into sterling, well, that could be a lot less than you're expecting if the rates have moved by a large amount in that time period. Also, companies unable to change their prices frequently can become uncompetitive. So it's really important to stay on top of these things to make sure that, first of all, you're making enough profit and you're staying competitive in your market. Going on to the next slide. Thanks. So section 2, 2024 market risks. Perfect. So starting off with the US election. So the good thing about the US election is it's a repeat of 4 years ago. So we kind of know what's going to happen in the market. Trump is seen as being strong for the dollar. The reason for that is he does seem to increase geopolitical risk. And as I said previously, as the dollar is a safe haven currency, then it will do well off the back of it. But the other thing to think about as well is that Trump's kind of policies are quite low taxes, and that's going to be an inflationary pressure in the US as well. That would mean that the Fed, the Federal Reserve, which is the central bank in the States, won't need to cut rates and actually may need to increase rates. And if they do that, that will increase the strength of the dollar as well. On to Biden. He's given the US politics to the polar opposite, as you can imagine, and he favors higher spending. This is kind of seen by the Inflation Reduction Act, which is investing in a load of green policies in the US over the last 4 years. With that will help reduce inflation, which will mean that the Fed's more likely to cut rates, and cutting rates will lead to a weaker dollar. What we're seeing at the moment is they're neck and neck in the polls. These polls were based off last week. Obviously, quite a major event happened on Saturday, and this may have changed things quite drastically. I'm sure you've all seen that famous photograph of Donald Trump. So what does that mean when we're expecting high volatility? Well, the markets like to know what's happening, and they don't know who's going to win at the moment. So that means we're going to see big swings if polls come out that show one's more likely than the other, or if we get to election day and it's still neck and neck, then overnight in the UK when the US go to the polls to vote, and we start getting the results in, then we're going to see big shifts overnight, and you could wake up and there could be a 5-6% change in the exchange rate. And obviously, if you're trying to do business during that, nobody likes uncertainty. So it's how we can manage that going forward. Cool. On to the next slide. Okay, the UK election and Labour landslide. So we're going to go through the short, medium and long term and what we think is going to happen. Now we've got a Labour government in power. So in terms of the short term, the pound has so far reacted well to the new government, and the election unfolded broadly as expected. There are no major surprises or rabbit out the hat policies. So for example, the Labour government previously, they came out and announced that the Bank of England would go independent. So there's a few political commentators wondering whether that is something that could happen. Something similar could happen again, which could shift the market drastically, but that didn't happen. So overall, it's been fairly stable, which is quite a good thing. And then onto the medium term, the pound may depreciate if the Labour government announces higher taxes or unfunded government spending. So typically, when we're looking at elections, UK elections, what it's seen for in terms of the pound is Conservatives normally makes the pound stronger, and Labour makes the pound weaker, and that's just because they view the Conservatives as a bit more pro-business and Labour as a bit more pro-spending. But Labour really need to find a way to boost the stagnating UK economy. If they can't do that, then we're going to see the pound weaken off over the long term. But we've obviously had the King's speech today, and they're releasing quite a few economic policies to kind of combat that. In terms of the long-term, investors markets like political and economic stability, and we're more willing to invest in the UK. So this should be positive in the pound. We've obviously had a bunch of political instability over the past 5 years with several prime ministers and the Conservatives coming in with different policies continuously. You know, foreign investors don't like that. So if Labour are able to keep a bit of more steady playing field, then we could see a bit more foreign investment, and it would be better for the pound. Cool. On to the next slide. Right, the French election. So this is the rise and fall of the far right. So there was a risk that the far right government in France was going to come in, and that was really going to weaken the euro off the back of it, and we've kind of seen that over the last couple of weeks. The reason for that is they're quite anti-EU, and we could see a potential kind of Frexit happen. And the markets really didn't like that, but that has managed to be avoided with a hung parliament. But this is actually a bit more of a bittersweet result for the euro. The reason for that is the left-wing alliance did a lot better than expected, and they cause a fiscal risk to France due to increased government spending and kind of higher taxes. So they're looking to increase the minimum wage and also bring the retirement age back down after Macron increased it, I think, a few months ago. So markets don't really like that. They're not really sure what's happening in France at the moment. They don't know which way it's going to swing, and that's why we're seeing quite a weak euro, especially against the pound at the moment. Okay, on to the next slide. Global easing. So this is when central banks start to cut rates. Inflation has started to fall around the world, so central banks are preparing to cut rates. It's a really difficult balancing act for them to cut at the right time, because they need to make sure that they're basically not stifling the economy by keeping inflation rates too high, but not cutting too soon so inflation goes back up again. So all these different central banks around the world are trying to work out when they're going to cut, and all the markets trying to second guess them as well. And as they do that, we're seeing the currencies move against each other. This is because currencies derive their value from their bank's interest rates. So obviously a rate cut would weaken the currencies. That's perfect. On to the next slide. Okay, section 3. So how do we actually help our clients manage their FX risks and help them save money? Spot contracts. So this is really simple. This is kind of a day-to-day trade that people use very often. That's when we're kind of settling the trade in 2 working days. Banks have been historically very expensive and slow when it comes to purchasing foreign currencies. So brokers such as Currency Solutions came into this space and helped them basically do it quicker, cheaper and faster. And we're often saving our customers thousands of pounds just being able to offer better exchange rates than they were able to get previously. On to the next slide. So forward contracts. This is one of the simplest hedging contracts that we offer. They're broken down into 2 types. You've got a fixed forward contract, which allows you to purchase currency at a rate available today for settlement at a set future point, and that will just settle on one day, for example, in 6 months' time. And then we also got a flexible forward contract, which is a lot more popular than a fixed, especially with everything changing in the world at the moment. For example, shipping times increasing, the rest of it. And what this allows you to do, for example, is to buy, let's say, 100,000 US dollars, and then you can draw down at any time before the settlement date. So if you need to pay a supplier £10,000, for example, you can do that. And then the next week you can pay $20,000 from it, and then the next week another $20,000. So it just means that you can fix that rate for that period of time, and then you can use it when you want. So it makes it really easy for our clients. A way that we helped a marketing client of mine is they had overseas contracts lasting 8 months, which they were getting paid in dollars for. Now, they knew how many dollars they were going to get paid in 8 months' time, but they obviously didn't know what the rate was going to be when they had to transact that back. So they got in contact with us. They hadn't really used any forward contracts before. They were originally just getting paid dollars straight into their sterling bank account, which was really expensive from their bank, and they contacted us to see if we could help them. So what we did is we booked in a forward contract for them. This was just after Liz Truss had her fun at number 10, and we managed to get a rate around the 112 level. Now, 8 months later, when they actually got the dollars and they needed to settle the contract, it had gone all the way up to above 120, and that meant that they were able to protect £50,000 of profit on that contract. And for a small marketing company, that was massive for them. So it just shows the importance of making sure that you are hedged and you're not exposed to these currency fluctuations. On to the next slide. Cool. Orders. So orders basically work. First of all, we've got market alerts. This is where we just simply, no trades booked or anything like that, but our clients will just tell us, like, can you let us know when we want to buy dollars when it gets to 130, and we will get in contact with them and let them know when it gets to that level. That's really good as well when our clients need to, if they've got contract negotiations in terms of pricing as well, and they need to know when we've hit a certain price, so we're there to keep them abreast of the market and what's going on. Then moving on to limit orders. This is when a trade is automatically booked at a desired level, so they let us know the amount they need to be bought or sold, and it will get booked automatically. The good thing about this and the benefit from this is the fact that these are live in the market as long as the FX markets are open, which is 24 hours a day, 5 days a week. So even if we see something happening overnight and we see a quick spike in the market, then our clients are able to take advantage of that and get rates that wouldn't be available when they're sat at their desk working 9 to 5, for example. Then we've got stop loss, which is basically a limit order. It's the same thing, but it just works on the downside. So if a client needs to basically know the worst rate, they know the worst rate that they need to get, they can put that in, and then if it ever drops below that, it will get booked in, and they know that they've protected that profit for themselves. And then an OCO, which stands for one cancels other, and this is where a limit order and a stop loss basically work in tandem. So it goes one above where the rate is at the moment, one below where the rate is, and if it hits one of them, then it triggers and cancels the other one. So it's really good because you know your best and worst case scenario, and these are used a lot around high volatility events such as elections or interest rate decisions when there's a lot of volatility. One of our clients that kind of uses this most is they're in a lucky position where they're really cash rich. So what they do is for half their exposure for the year, they book forwards out, so they know exactly what they're getting for that amount. And then on the other half, because they've got time and the cash to play with, they'll place the limit orders selling the dollars back into sterling, and they'll place it at levels below the market, and then they've got a whole year to play around with it and kind of eke out those currency gains and make a bit more profit for themselves, which is really good. And on to the next slide. Perfect. Options. So these are regulated products that may not be suitable for all our clients. They offer a protection rate like a forward, but also allow for some upsides if the rates improve in our client's favor. The protection rate, it tends to be less favorable than the forward, and that's kind of the trade-off for being able to get that the option on it and be able to get the upside. There are loads of different option products that all have their own pros and cons. So if you are interested in this, it's best to speak to one of our option dealers here who can basically structure something bespokely for yourself, and you can basically tell them what your financial goals are or what you need to achieve, and they can create these products for you. But as I said, they are regulated, so you just have to go through a bit more of an onboarding process to make sure that they are suitable for you. And on to the next slide. Perfect. So currency accounts and exotic currencies. So first of all, currency accounts, we're able to set up accounts in our clients' names. So these are basically known as virtual IBAN accounts. This helps them save time and potential bank fees. So I was working with a new recruitment company recently, and they were speaking to their high street bank about trying to open a dollar account because they needed dollars to get paid in by one of their clients, and Barclays told them it was going to take 3 months to set up. Now obviously the new business, they need those dollars in their account as quickly as possible because they're not cash rich, so they can start, sell it back in sterling and take their profit and pay for all their business costs. So what we were able to do was in a day, is set them up with a dollar account and get their client to pay into that account. And it also works is we're able to offer local pay and collection. So what that means is we're able to give them dollar account details that are actually based in the USA. So their clients themselves can make a domestic payment to that account, so it makes it really easy for them and inexpensive, because US banks can be quite expensive for making international payments, so it makes it easy for their clients, and then it just gets received, and they basically then take it out and use it as they want in the UK. This also works when they're paying abroad as well, especially paying into developing nations. That can be really expensive to try and get funds to a local bank account, and be able to go through a local payment method can save loads of fees on that side. And then lastly, exotic currencies. So these are basically currencies outside of the G10, which tend to be for developing nations and can be very expensive to buy because there's not that much liquidity in the market. So our clients will come to us and say, look, we've got a project out in Brazil that we need to pay for, but either we have to send dollars there to Brazil, but the invoice is really, really expensive because they're putting the exchange rate fee to cover them doing the FX on the other side and changing that into dollars back into Brazilian. So what we're able to do is speak to our liquidity providers and find them a line to purchase these exotic currencies and save them thousands of pounds because we're able to offer them different options opposed to just using their bank. And on to the next slide. Perfect. So I know that was quite a lot of information, and the way to kind of break it down is that all our clients, they don't just use one product, they use several products at the same time. The best way that we really do it is when we're speaking to our clients is they do more of the talking, we just ask the questions and we can get a deep understanding of how they work, and then they can basically suggest to them what combination of products can work to help them protect their profit margins, basically. If you want to hear any more about this, feel free to contact me on the details on the page now. Thanks a lot.
Great, thanks, James. That was really interesting 20 minutes, and I hope everyone's got a lot of takeaways there. Just before I hand over to Garima, though, I'd like to run another poll. So this one is, this is whether you'd like to hear more from Currency Solutions about their products and services. So if you do choose to opt in, a representative from Currency Solutions will be in touch in the near future. While that runs, very quickly from the Q&A section, we've got a few already filtering in. Do keep them running. We do really value the questions. Even if we don't ask them this time, we'll try and find a way to get that kind of feedback in. But before I go on, so this one's from Nick. We're thinking of changing provider. How long does it take to set up an account with Currency Solutions? James, what would you sort of expect?
So because we're an FCA regulated financial services company, we basically have to go through our standard KYC process, which is know your client. But we try to get any kind of UK business open within 2 days, as long as they can get all the documents back to us in time.
Brilliant. That's a very succinct answer. On the topic of forward contracts, Amy is asking, is there a minimum amount that would be needed for a forward contract?
Yeah, no problem at all. So for us personally, we tend not to purchase a forward contract below £10,000 worth in sterling. But our clients who are interested in forward contracts tend to be doing significantly over that anyway.
Okay, thank you. Amy, hope that was helpful. So I'm just going to close the poll now. Thank you to everyone who voted. Those who said yes, Currency Solutions will be in touch in the near future. But thank you for James for that section. He'll be back when we get to the Q&A. But for now, I'd like to hand over to Garima. Over to you, Garima, for your section of the presentation.
Thank you, Phil, and thank you everyone for joining today's session on currency and export strategies. My name is Garima, and I am an international trade legislation senior advisor at the Chartered Institute of Export and International Trade. In today's discussion, we'll try and delve into the impact of currency on export strategies, which seems like a logical corollary to what James has just talked about. We'll get into the regulatory and customs compliance aspects, and we'll also talk about a few negotiation tactics with trade partners. Could we move on to the agenda for today? So we'll start with export pricing strategy, then we'll discuss regulatory and customs compliance, and then again negotiating with trade partners. Now let's see how currency fluctuations tie into exports. So any sort of fluctuation significantly impacts customs procedures and compliance in international trade. Exchange rate volatility influences customs valuation in particular, and thereafter duty calculations and overall compliance as well. For instance, a UK exporter dealing with European clients must be aware of how the GBP euro exchange rate affects their pricing and profitability. And here I would like to give a very simple example. A British electronics company exports to Germany. When the GBP strengthens, their products become more expensive in euros, potentially reducing competitiveness. Conversely, a weaker GBP makes their exports cheaper and more attractive to German buyers. Could we move to the next one? Exchange rates play a crucial role in market competitiveness, just like we discussed in the previous example. So a weaker domestic currency can make exports more attractive by lowering prices for foreign buyers, while a stronger currency has the opposite effect, just as we saw now. This also affects the cost of raw materials, just in a similar way, and production inputs sourced internationally. Now, in that case, we usually talk about dynamic pricing models, which are essential to account for real-time exchange rate fluctuations, protecting profit margins, and maintaining competitiveness. For example, we've often seen that Japanese companies employ such dynamic pricing models. So they have such a model that updates weekly based on current exchange rates to ensure competitive pricing in different markets, especially in the US market. The next one, please. Right. So exchange rate volatility can significantly impact the cost and profitability of international trade transactions, just like we've talked. Exporters need to analyze any historical exchange rate trends and forecast potential fluctuations. There are hedging strategies that James just talked about. So you could use financial instruments like forward contracts, options, and swaps. And these can help managing risks by locking in exchange rates and providing predictability. Without getting into the details of hedging, which we've already talked about, I would like to move on to the next segment of my presentation, which talks about how customs is exactly impacted. So moving on to the next one. Right, so regulatory and customs compliance. The next one. Right, so the first and foremost thing that we should look into is customs valuation, which primarily relies on transaction value. Now, what is transaction value? It is the price actually paid or payable for goods when sold for export to the importing country. And this value must be converted into the local currency at the time of import. And that is why accurate conversion is crucial, as most duties are ad valorem and are calculated as a percentage of the customs value, directly affecting duty payable due to currency fluctuations. Now, just to make it simpler, just to break it down, we can take an example where an Italian fashion brand exporting to the US uses the transaction value method for customs valuation and converts prices based on the applicable exchange rate at the time of export. So customs valuation is directly impacted by any sort of currency fluctuations, and customs authorities typically use a specified exchange rate, which might be published periodically. So you have to look out for such publications. These may differ on the basis of the jurisdiction that we are talking about. And depending on that, importers must use the correct rate for the date of export. And this usually fluctuates between shipment and customs clearance. So just keeping a track on the rates would be very useful. The next one. So documentation and reporting, again, very essential. Accurate and timely reporting of currency transactions is critical for compliance with the international trade regulations. So exporters must maintain records of exchange rates applied at the time of transaction and import, ensuring consistency across all documentation. Moving on to the next one. So here we'll try and talk about different kinds of terms and conditions that we should be focusing on. So when dealing with trade partners, it's important to draft out your contracts in certain ways so as to minimize your risks. So the next one. Payment terms and conditions, including the timing and methods of payment, are crucial in managing currency risks. Incoterms influence the point at which currency exchange risks transfers from seller to buyer. So it's important to determine your Incoterm very clearly in your contracts. Different kinds of Incoterms such as FOB, CIF, cost insurance and freight, etc. So it has to, your Incoterms will clearly define your responsibilities and risks, and it helps both parties manage their currency exposure. So it's very important to define your payment terms and conditions, look into your Incoterms, decide what the responsibilities are going to look like. The next one. The choice of invoicing currency also affects exchange rate risk exposure. So when you're getting into a contract, you've already decided what the payment terms would be when the payment comes, what is the amount of risk that you are agreeing to take, what the Incoterms will look like, where the responsibilities will exactly transfer. Now then it's important also to determine whether to invoice in the exporter's currency or the importer's currency, or sometimes the parties can also decide a third-party stable currency. So this requires a careful consideration of negotiation leverage and market conditions. And here it's also important to understand who holds the most bargaining power, or who is on the negotiating table. So you might want to see, you might experience that exporters who are in stronger positions may want to push for an invoicing in their currency or their preferred currency. So keeping all these in mind would be essential, especially determining the currency, because the fluctuation will directly depend on the currency that you're picking. For example, a Canadian exporter invoices South American buyers in CAD, which is Canadian dollars, but includes a currency fluctuation clause that allows price adjustments if the CAD fluctuates by more than 5%. So such clauses will help you minimize your risks or define your risks, what risks you're prepared to take and what you're not prepared to take. The next one. Effective supply chain coordination is also important, and it essentially involves negotiating with suppliers to manage currency risk. And how are you going to negotiate with your supplier depends on your communication channels, how regularly you're communicating with your partners, what kind of strategies you're building with your partners. So sometimes it's important to maintain open lines of communication. So whenever there's any potential exchange rate impacts, or there are any potential risks that are foreseeable, it's important to have that kind of communication and agree on solutions that are mutually beneficial to both the parties. It's like I said, it's also important to set out everything within your contract, determine everything within your contract, such as agreed currency, payment terms, any contingencies as well, so as to limit your risks within the contract. And of course, adjusting inventory strategies are also beneficial. So you may have some understanding on adjusting inventory strategies to account for any currency fluctuations. And it depends. I mean, it's a contract, and whatever the parties agree will be interpreted by the court in that way. But it's important to make that understanding very clear, how you will adjust your inventories. For example, if there's increase in inventory levels when the currency is strong, how you'll take advantage of lower import costs, etc. So all of that has to be determined, and the most important pillar is regular communication. The next one, please. Right. So now we've talked about how we're going to deal with our partners, our trade partners. Now, it's also important to understand what kind of technological tools are there in the market that are helping traders monitor exchange rates. So utilizing real-time data and automated systems for currency management is essential. And there are different kinds of systems, for example, ERP systems with integrated currency management features, which can automate invoicing, payment tracking, and compliance reporting. And most companies that I have talked to regarding currency fluctuations use certain systems to monitor real-time exchange rates, and they ensure that timely updates to pricing and financial records are made. And I'm sure that Currency Solutions has also talked about certain services, certain products that they are offering, which are worth exploring. The next one. All right, so I do have a few examples here. So in 2015, for example, a US tech company adjusted its pricing strategy due to a strong USD, raising prices to maintain profit margins. We've talked about Japanese companies, typically the electronics industry. So they like to update their pricing on a weekly basis based on current exchange rates to stay competitive in the market. Another example of a Canadian exporter, which included a currency fluctuation clause in their contracts with South American buyers that we have talked about, and this allowed for price adjustments. So depending on the fluctuation, the price adjustment could be done by whatever they would have decided, but the fluctuation has to be close to 5% or below 5%. So these are the kind of clauses that you could have. There were a few other clauses that I wanted to discuss. For example, the Incoterms. So you have to be very clear on your Incoterms. We have dealt with a Singaporean electronics exporter, which maintained precise trade documents to comply with Asian agreements. So they had to have proper documentation in terms of rules of origin or in terms of customs valuation. So to have such a record or repository for all for the customs valuation piece or for any sort of exchange rate calibration that you're making in your customs value, and having records to support that is always beneficial. The next one, please.
Thank you. Oh,
yeah.
Go on, sorry, Garima.
No worries, no worries. We do have a question here. Go ahead, Bill.
We do. So just before we get to the Q&A section where Garima and James will be answering some of your questions, one of the final polls. So how do currency fluctuations impact your export pricing strategy? So yeah, I'll just let that run for a second. Just one question. So to Garima, I guess could you explain how do fluctuation in exchange rates impact things like customs valuations of imported goods?
Yeah, right. So I have talked about customs valuation, and the most important aspect within customs as far as currency fluctuation is concerned is the value of goods. So fluctuations in exchange rates typically can affect customs valuation by altering the value of goods in the local currency of the importing country at the time of importation. And customs authorities typically require the declared value to be based on the transaction value in the exporter's currency, converted into the importer's currency using the exchange rate prevailing at the time of importation. So, which is because of this conversion, usually the value of goods are getting impacted because it's important to do that conversion at the time of importation, which might differ between the time when the goods are shipped and the time when the goods are actually hitting the customs authority in the importing country.
Brilliant, thank you. We'd had a couple of questions along that line, so I thought I'd kind of summarize them in one rather than asking them as a group. But on that note, if any other attendees do have any questions, please pop them down the chat. We've got a few we're going to get to in a second once the poll is hitting 2 minutes. Most people have voted now. I'll close it in 5, 4, 3, 2, 1. And it is actually a dead heat. So 38% said they significantly adjust prices frequently. And the other 38% say they currency fluctuations moderately impact their pricing strategy, saying they adjust prices occasionally. Only 23% said they rarely adjust prices, so it didn't have much an impact. Notably, no one said at all. Everyone said it had some impact. Garima, what do you make of this?
I think I see that people are adjusting prices frequently. So adjusting export pricing in response to a buyer's currency depreciation, for example, is all about staying flexible and proactive. And dynamic pricing is key here. It's about adjusting your prices in real time based on exchange rate fluctuations. So I think it's a good sign that people do have that kind of flexibility and proactiveness within their contractual arrangements.
Great, thank you very much. Thank you everyone who responded. We do very much value your feedback. However, without further ado, it is now over to the Q&A section. So this is a chance to ask Garima and James any questions you may have on foreign exchange and exports. So the first one is to James. So aside from the US elections, and I think we can add the big event that happened on Sunday, what other triggers could there be for FX volatility? That one is from Adam.
Perfect.
So
thanks,
James.
Adam, for the question. So I think something that we need to be aware of is kind of the China-Taiwan tensions that were bubbling away at the beginning of the year, but seemed to calm down a little bit. I think if we do get Trump coming in to become US president as well towards the end of the year, he is very focused on the US, and he's not too concerned about wars around the world. He's kind of made that quite well known. If we did see that and we saw rising global tensions again, then we'd kind of expect to see a strong US dollar off the back of it. But as I kind of alluded to in my presentation of what causes FX volatility, there's so much that goes into it that anything could come out of the blue. And if you're not hedging your FX risk, you're speculating on it, and you could be hit at any chance because anything could happen, however unlikely.
Brilliant. Thank you, James, and thanks, Adam, for your question. The second one, I'm going to put this to both of you, and this touches on what Garima's talked about above. How would you adjust your export pricing strategy in response to a significant depreciation of buyer's currency? That one's from Sarah.
Well, I think you have to start by reviewing your cost structures. If your buyer's currency depreciates, your imported raw materials or production costs could go up, impacting your profitability. And I think just taking an example, if you're exporting to Europe and the euro weakens against your home currency, adjusting the euro denominated prices properly can help you maintain market competitiveness. Yeah, so that's from me.
James?
Yeah, I think it's important to, when looking at this, is to try and have as much flexibility in it as well. So you don't want to, especially when you're, what Greedy was saying, when negotiating contracts, you really don't want to put yourself in a place where you have no movement at all. So I think what you were saying is, for example, about the Canadian company that has that kind of 5% flex before they can renegotiate it is really important and something that you should be looking at.
Thank you both for your answers. I hope that answered your question. This one is from Bradley. I think this might be one more for Garima, but James, feel free to drop in. How do we justify to customs where we are shipping an item whose value has changed significantly from previous shipments of the same part due to currency fluctuations? That one is from Bradley. Garima?
Yeah, sure. So that's a very good question, and this is a very typical case, and we've dealt with this in the past. Typically, exporters are required to accurately reflect the value of goods on customs documentation, and they also have to adequately document the exchange rate applicable at the time of export. So any significant discrepancies due to currency fluctuations should also be clearly documented, so that you're able to justify to customs authorities as to how the currency has fluctuated and what was the rate at the time of export and what it is now. And this will ensure compliance with valuation regulations, because it's not your job to control the fluctuations, but it is your job to record the fluctuations. For example, we had seen a Canadian seafood exporter who had invoiced a shipment of lobster to Hong Kong in Canadian dollars. At the time of invoicing, let's say 1 Canadian dollar was equivalent to 7 HKD. However, due to currency volatility, the exchange rate had changed to 1 Canadian dollar amounted to 6.80 HKD by the time the shipment reached Hong Kong. So the exporter there was only required to provide documentation showing the exchange rate used at the time of invoicing, or provide a valid reason for any difference to avoid customs delays or penalties. So they were able to show the difference, and therefore they were able to justify their values.
Thank you, Garima. Bradley, I hope that was helpful. The next one is from Lee Cat. Apologies if I mispronounced your name. This one may be for James. What do you think the impact will be on GB and the euro, on the pound and the euro exchange rates on a Biden and a Trump win? Is that something you could give some insight on, or is that a bit too speculative?
No, we can talk about that. Again, I'll have to use caveat this with anything can happen. So please don't take my word as investment advice or anything like that, because it's not. What we're likely to see is Biden's always been quite pro Europe. He likes to kind of lean on his Irish heritage, and he's very keen on the European Union. So he's likely to be kind of pro the euro, so we're likely to see some euro strengths off the back of a Biden presidency. On the other hand, Trump's likely to come in, and he's actually probably going to put some trade tariffs in place because he's very nationalistic. That's going to really weaken off the euro in comparison. In terms of kind of the sterling euro exchange rate, the way that something called currency triangulation is, they should pretty much remain the same in terms of what's happening with the dollar. But if we did see Trump come in and weaken off the euro, then there would be kind of a knock-on effect. So you'd seen the pound do well against the euro, but obviously there would be other implications with what was happening against the pound, which could change that. So unfortunately, you can't really give a binary answer. But you kind of, if you want to break it down really simplistically, you could say Trump's going to be bad for the euro and Biden's going to be good.
Brilliant. Thanks, James. That was a really comprehensive answer. Just to add that on the daily update, which is the Chartered Institute's regular newsletter for members and non-members, we do cover a lot of geopolitical issues like this. So if you're not already subscribed, please do consider signing up and getting regular updates on things like this. We have another question we've just got in from Oluwayomi. At what point does currency volatility affect shipments being exported? Garima, this might be one for you.
Sorry, could you go again, Phil?
Certainly, this is from Oluwayomi. At what point does currency volatility affect shipments being exported?
So typically, exporters must accurately reflect the value of goods at the time of export. So between the time of export to the time when the shipment hits the port of the importing country, that is the time when the currency will typically fluctuate. So you have to compare the value as it was on the date of export and as it is on the date of importation. And that point of time, you'll have to show the customs authorities that this is what you agreed, this was on your invoice, and thereafter there has been a considerable fluctuation, and which is why your value is justified. So you have the records, you show at the time of importation, on the date of importation, that this is what you agreed, this is what you invoiced on, and here you are at the date on the date of importation, and this is how the currency has impacted your customs value. But this is still justified because you have the adequate documentation.
Perfect, thank you. Oluwayomi, hope that was useful. We've got about 4 minutes left, so I'm going to ask one more question. This is more of a general one we've gotten in from Kirk. What should we be watching for? What should we be watching out for in terms of currency fluctuations? I suppose there are any sort of more major events we're looking out for, or there anything like that? James, do you want to come in on that one first?
Yeah, for sure. So kind of if we're going to look in the short term, what we've got coming up in the next few weeks in terms of fluctuations, especially if you're dealing in sterling, we've got the Bank of England on the 1st of August. This is, as I said, we had the inflation data come out this morning a bit higher. This is what the market is kind of looking at, especially for the pound. What they're really trying to work out is when the Bank of England are going to start cutting rates, and when they do, we should see the pound drop off the back of it. If they don't and they push it out another month to September, then we could see the pound jump up a bit higher, like we've kind of seen this morning. So I'd say away from the kind of the political stuff and anything that could come out of the blue, being aware of what the Bank of England are going to do, especially if we're just specifically talking about sterling, then that's something to keep an eye on and be aware of.
Thanks, James. Garima, do you have any insights on that one?
I think from a customs point of view, it's important to remember that exchange rate fluctuations affect customs valuation. And I have covered this in my presentation, but I'm highlighting this again, that customs authorities typically require the use of a specified exchange rate to convert the transaction value into the local currency for duty assessment. So importers must ensure that they use the correct exchange rate at the time of importation, just in case their customs authorities has listed or has announced something to that effect. And this will help them avoid any sort of discrepancies or potential penalty in relation to customs valuation.
Brilliant, thank you very much. I'm just going to, well, I'm going to end that section of the Q&A. We've only got a couple minutes left, so I'd like to go to the close. So the final poll from us would be on the type of training you'd want for. This is multiple choice, so feel free to select as many or as few as you want. So what kind of training would you want to help you understand trade finance, interactive workshops, lunchtime learning sessions, online courses, or tailored coaching? And on the topic of lunchtime learning sessions, any of our members can attend tomorrow's session on free trade agreements, which, funnily enough, is actually being hosted in part by Garima, who will be helping you understand some of the ins and outs of the ongoing free trade agreement landscape. I'm just going to let that poll run. I'd also like to take the time to remind you that the Chartered Institute is here to support you with any trade you might have, and we do have a range of training and consultancy solutions you can explore on our website, export.org.uk. This includes things like the practical workshops, which offer hands-on learning experiences and are very well received. So please do keep an eye out on the website.
Just to add to that, Phil, we do have training courses specifically on Incoterms, international trade finance and letters of credit, and customs procedures and documentation. And you're also more than welcome to attend our practical workshop on customs valuation and our upcoming lunchtime learning on Incoterms on the 19th of September.
Thank you for reminding me of that, Garima. Yes, we do have all these. So do check out our website if you'd like to know more. I'm just going to let the poll run for another second or two. Most had voted. Thank you for everyone who does input. We do greatly appreciate the feedback. That is almost it from me. So I'd like to just go to the last slide whilst we say thank you. Firstly, thank you everyone for taking time out of your busy day to attend this. We do appreciate that. Secondly, I'd like to give a massive thank you to James of Currency Solutions. Thank you for partnering with us on this webinar and other things. Thank you, James.
Thanks a lot for having me. It's been great.
Been a pleasure. Thank you to Garima for also joining, giving some of her expertise. Our members can see her tomorrow on the Lunchtime Learning. Thank you, Garima.
Thank you so much, Phil.
Otherwise, it's thank you from me. I hope you have a good evening. Thanks, everyone. Bye-bye.